Hello, this is David Lucas, and this is the accompanying video to the broadcast that was on December 7th, Saturday, on the David Lucas Show on our affiliate station, KARN 102.9, and many of you are watching either from your official David Lucas Show smartphone app or from the website or from your iPad or whatever it may be. So glad that you took the time to watch this. I think this is key that you understand this concept that we talked about on this particular broadcast. I'm going to use a little bit different numbers than I used on the broadcast that aired on KARN and the podcast and the audio, but the big idea is just the same. So we're going to look at the same period of 35 years, and current assets we will just leave at zero at this point, and let's say an annual income of $250,000 with an annual income increase each and every year of 4%. So just to recap, we're looking over a 35-year period. Annual income, I put 25,000. There we go. Too few zeros. $250,000 in annual income. An annual income increase assumption of 4%. The idea is we hope that would keep us up with inflation, the inflation of the money supply. And then annual earnings rate, we're going to start out at a true rate of return of 5%. All right, so a couple things that I want to point out here. This is our maximum lifetime potential would be, if you see total income is there, $18,413,056. Compounded at 5%, if we could invest 100% of our earnings over this 35-year period. In other words, we had no expenses, we paid no taxes, we didn't have to live, no lifestyle money, no dollars going to lifestyle. We had absolutely no expenses. For sake of this example again, that of course this isn't true in the real world, but it's just for you to get the big idea that if you were able to invest what I would call your lifetime capital potential, your cumulative total income over that 35-year period, as you can see, would be $18,413,000.56, invested through the magic of compounding interest over 35 years at 5%, and the total is $41,210,000. Of course, in the real world, we have to pay taxes. So we are going to, in this example, assume a rate of 40%. Federal, state, county, local, 40%. And as I talked about in the broadcast, most likely taxes are going up in the future when you study what is going on today at the time of this video. Now what you can see has happened is, of course, our cumulative lifetime total income remains the same at $18,413,000, but our savings has been reduced significantly, and you can see now it's down to $24,726,000. The number above, $11,047,834, is the amount we were able to put towards savings, and through the magic of compounding interest, the $24 million number below is what we would be able to accumulate. However, there's more things that take place in the real world. Debt. The average American, as I talked about in that broadcast, and I will discuss here, is 34.5%. So I'll put that back in there, 34.5%. And we're talking about mortgage, credit card payments, student loan payments, you name it, anything, any type of debt whatsoever. The average American, their mortgage payment alone consumes at least 25% of their gross income. Many, it goes much higher than that. Now what we can see is that's reduced, of course, our potential savings. We had $4.6 million available for investment, which through the magic of compounding interest turned into $10,508,695. However, we know in the real world that you have to live. And I talk about this in my book extensively, Whose Future Are You Financing? And basically, lifestyle money is the money you're spending today to maintain your standard of living. The house you live in, the cars you drive, the vacations you take, how many times you eat out. In other words, the money going towards your your household income going towards your lifestyle. So let's say 22%, which in this case leaves us with 3.5% net to savings. And this is your average American Joe out there. Very little is going to savings. And we can see here now cumulative savings in 35 years compounded is $1.4 million. Now, what is it that we can do to fix this problem? Well, oftentimes when an individual sits down with an advisor, the individual is we all do for that matter, let's be honest, we don't get really excited about reducing our lifestyle. A financial advisor or someone telling us, well, what you need to do is stop going on vacation so much, or what you need to do is stop eating out so much, or what you need to do is, in other words, pare back or cut back your lifestyle. Of course, the debt service is going to have a real impact, and of course, taxes. Well, what is the typical response to this? Well, Mr. Investor, you're only getting 5%. You need to take more risk. As I talked about in the broadcast on December the 7th, when it originally aired on KARN, I talked about the importance of understanding why much of the prevalent mindset of achieving retirement savings objectives is often synonymous with taking more risk. And as I talked about, risk can be defined as exposure to loss. So what are some synonyms for risk? Well, they include to endanger, to jeopardize, to gamble with, to take chance, to put on the line, to put in jeopardy. So the greatest definition of risk is the likelihood of loss. So most people mistakenly believe and associate risk, especially when it comes to retirement savings, with the probability they will hit it out of the park, quote unquote, or win big. So by experiencing higher rates of return, again, the true definition of risk is the likelihood of loss. Now, let's think about this logic for a moment. You have to take a chance of losing everything so you can get more money ahead and save for retirement. It doesn't logically make sense. But again, this is what the common focus is, rates of return. So, Mr. Investor, you're only getting 5%. You need to dump it all in the market. Over time, you can get 12%, says the famous radio show host Dave Ramsey. Claims you can get 12% real rate of return year in and year out in the market. And we'll save that for another video. I've written on that topic extensively. But nonetheless, many people believe that this is what they can do year in and year out. So 12%. Now we see that our savings has gone from well, let's see. Let me go back to 5% to follow this. 1,442,000 over 35 years, but look at our last year's income, because inflation, I know this seems hard to believe, but our last year's income is 948,579 35 years later, increasing at 4% per year. Well, that's barely a year's income. So 1.4 million, if we follow the typical advice, 12%, if we could achieve that. Okay, now we've got almost $6 million saved, and our last year's income is close to $1 million 35 years from now. But remember, it would have, if there was a 4% inflation rate year in and year out, then it would be the same purchasing power as $250,000 is today. So now we see almost $6 million, which is a little over 6 years worth of income. So now, to illustrate my point, what if we could identify, and I talk about this in my book, Whose Future You Financing, what the government and Wall Street don't want you to know. I talk about this extensively, what we call wealth transfers. Well, one of your largest wealth transfers that erodes your wealth is taxation. And a dollar paid in taxes unnecessarily not only costs you that dollar, but what that dollar could have earned you had you not transferred it away or given it away unnecessarily. So let's assume we can take you could identify taxes that you were spending unnecessarily or paying. And I see this time and time again with my clients, and Darren Hamilton, a CPA who I've talked to extensively in his research, he has said that at least a quarter to a third of people are paying taxes unnecessarily. So let's say we reduce that to from 40% down to 36%. So we go from 1.4 million to 3 million. And let's say maybe we couldn't reduce the debt service to zero, but by identifying unnecessary wealth transfers and being more efficient with the way you handle your major capital purchases and your cash flow, as I've said many times, the way you spend your money is equally as important as the act of actually saving your money. So let's say you could reduce your debt service to 15. Well, now we see that your income or the potential savings 35 years from now is over $11 million. The point is, the big idea of this is to show you how, by focusing on, again, if you could be, every person is different, reduce that debt service more and more and identify unnecessary taxes that are being paid. We've gone to over $14 million. Now, this is an overly simplistic example, but to show you how focusing on minimizing areas of risk and loss is good financial management. In other words, focusing on these things right here, take no risk. Following the typical advice, chasing higher rates of return, as you could see, did not even have as large of an impact as did focusing on being more efficient with your debt service, or what I talk about extensively in my book is creating your own personal monetary system. Some people call it privatized banking. I hope this exercise in financial education challenges your presumptions, or assumptions I should say, on what you should be focusing on. It isn't always rates of return. This is David Lucas. I hope you found this informative. Until next time, thanks for watching.